number one on the list, short-term interest rates are going to go up probably at least 1%. Federal Reserve, they keep raising the rates. We're sitting at about 3.8 today, as the 10-year Treasury is trading at right now. That means we're going to be probably seeing close to 5%, 4.8 to 5% as the 10-year Treasury.
So with the 10-year Treasury being at 3.8, does that is what all the rates go off of, correct?
Yeah.
And is it usually, like, what makes the rate 4.8 to 5% if the Treasury is 3.8, just for the people who don't know?
So if it's at 3, well, we're predicting that it's going to go up at least 1 full percent. I think
Yeah.
that's going to happen by about summertime,
Uh-huh.
and then it'll cool down. So prime is 100 to 200 basis points above that. So if the 10-year Treasury is trading at what we believe it will be,
Yeah, 4.8.
at 4.8, let's just say that, not necessarily
Yeah.
reach to 5, then prime lending rates are going to be 5.8 to 6.8, somewhere
Okay.
in that ballpark.
And so in your opinion, what do you think is going to make the rate go up by 1%? The
I
10-year
just
Treasury.
think the Fed's going to
They're just going to
continue to do it. They are, of course, they did nothing for a long time when when inflation was looking like that, and now they're going to make sure they stamp it out, maybe to a deeper recession potentially. I don't know if that's what will happen overall, other than that's his prediction is 1%. I think I agree with that by summer of 2023.
So you think it's just more correction from all the stuff that went on during COVID?
Yep.
Okay.
Yeah, I do think
Gotcha.
so.
Yeah.
That and the additional money being dumped in. I mean,
Yeah.
all the factors that led up to that inflation hike, I think we're going to be in that, and I think maybe it'll come back down a little bit, after that. But that's, of course, capitalization, which is item number 2. Cap rates will increase 1 to 2%. Now, the Fed increases short-term interest rates. Commercial real estate, it's going to have the average cap rate out there will go maybe up to 7 cap, right? So I mean, if we're sitting at 5.8 to 6.8 prime lending rate, 7.
Yeah. So cap rate is essentially just what the average consumer could get their rate at, correct?
Yeah. The cap rate is what evaluation. So evaluation of quickly you can take the net operating income, capitalize that on a certain percentage. Well, the lower the percentage rate, the higher the value is going to be on that property that you could pay to get that return. Interest rates have gone up, and there's that spread.
Yeah.
It shouldn't be less than what the interest rates are.
Yeah.
It's hard. Now, I do predict, which is item number 3, the cap rates for multifamily and industrial. They're going to be very close to what I think prime rate's going to be. In fact, maybe even a little more aggressive. There might be a little bit of a negative spread on what the financing rate is. I think that because rates are, we're talking interest rates, lease rates, I think will continue to outpace a little bit for the demand that's there.
Yeah. So you
And
think
so people are going to buy it knowing that there's a little bit of a negative spread in the beginning. They're probably going to have to come in with more cash, down payment, and then we'll see rates continue to come up, and that's what they're going to base their evaluation on.
So you think that the leasing payments will be more than what the actual, essentially the mortgage payment would be, correct?
Yeah, and I think the lease rate is going to just increase some from where it's at right now. Where the market is, I think we've still got some more room to have in those sectors. I mean, not all markets, but I think across the country for the most part, they've just been trading at that cap rate. So I mean, cap rate's probably somewhere on multifamily. It's going to be somewhere between. Instead of 3 to 4% cap rate, it's going to be 5.5, 5 to 6%.
Yeah.
That's a significant jump.
Yeah.
That's going to take the value of those properties down.
Yeah.
And that's what's going to happen. It's math at this point, and so I mean, even though they're performing very well, and they're going to be really close to what the prime rate mortgage lending rate is going to be, it's the values are going to come down just based on that capitalization rate.
Yeah.
Matching up with the market. Bid, ask, number 4. We see that right now it's wide, right?
Yeah.
I mean, here's what we're asking for the property, and here's where the offers are coming in at. It's
So offers are coming
It's a
in
Grand
lower.
Canyon. You know what I mean? We're talking. I mean, there's a big spread right now with what people are offering on properties. Here's what we're asking because of the cap rates catching up to that in the market. It's what we talked about the last item number 3, but in 4, we're saying that it's going to have to come together. The spread will narrow significantly. Sellers become more realistic. They're either going to pull their properties off the market and not sell them, but the ones that are looking to sell, if they've got the value that they feel like they still can, 2023, that's what we're going to see.
Yeah. So even though the people looking to buy, maybe they can't get as much for their money because interest rates are higher, the prices are probably going to come down, is what you're saying.
I think so. Yep.
So
there's
it'll
a
even
reality
itself
that's
out.
happening there. I mean, it kind of goes hand in hand with what I'm saying for item number 3.
Yeah.
Specifically for the multifamily and industrial where it's been so strong. So I think maybe it's going to be that even more so for office. Retail is looking good for 2023, but you know, we're going to have some type of that Grand Canyon is going to become a little tight. It's going to come to reality of where the market will trade at, and that's what we're going to see, I think, in the first 6 months of 2023.
Yeah.
Interestingly, which is not a topic or a product type that we track often, but it is a gauge in the market, and we do track it overall. Hotel. The hospitality industry, hotels are the most favored investment going in. He makes a good point that they were decimated so much in the pandemic, right?
Yeah.
I mean, nobody was traveling.
Yeah, no one went to hotels.
They really got slaughtered,
Yeah.
right? And they were already with Airbnb and a lot of other pressures there. 2021, they were hit hard. Many of the hotels were sold in 21 at like 60% on the, 60 cents on the dollar.
Yeah.
And just because there was that type of
Well, and they probably couldn't
correction.
make rent either.
Yeah, and so I think the reason that the author of this says that it is going to be one of the best performing is the lease rate is for one day, one night.
Yeah.
So they don't have to hedge on where inflation's going to go. They can move it on a daily basis, and they can do
Adjust their
that.
pricing accordingly.
Yep.